Good morning from London. I'm Kriti Gupta alongside Guy Johnson and Lizzie Burden. We're an hour away from the opening trade. Here's what you need to know. The world braces for Iran's response after the United States deployed bunker-busting bombs across 3 nuclear sites, marking the first time they've ever been used in combat. Now, all eyes on the Strait of Hormuz, used to transport as much as a quarter of the world's oil, with a widening conflict that could also threaten to disrupt global airline traffic. And foreign ministers, as well as Canadian Prime Minister Mark Carney, meeting in Brussels ahead of tomorrow's NATO summit as Europe braces for escalation in the Middle East. We're live in The Hague. Lizzie.
Well, Chrissy, you say it's all eyes on the Strait of Hormuz. In markets, it's all eyes on oil as we await Iran's reaction to the US strikes on its nuclear facilities. $78 a barrel is where we trade at the moment, so pairing some of the earlier gains. But it's a risk-off mood, subdued in these markets as we look at the futures on both sides of the Atlantic, pointing lower. The dollar as a safe haven asset reactivated, and therefore euro-dollar slightly on the back foot this morning at 1.15 at the moment. The countdown to the opening trade starts right now.
Iran's key nuclear enrichment facilities have been completely and totally obliterated.
The world must not forget that it was the United States which, in the midst of a process to forge a diplomatic outcome, betrayed diplomacy.
Monday morning, good morning. Markets feel remarkably calm. It is an amazing outcome considering what we thought could happen once the US got involved. But the signal this morning is there is nothing to see here. The signal, Lizzie, is that Iran cannot respond in a way that disrupts global trade. That seems to be the feeling this morning. Oil is barely higher. If you'd have said to me on Monday morning, after the Americans got involved, that oil will be up 1.5%, that we barely see a budge in equity futures, I'd have maybe questioned that, but that is the response this morning.
Yeah, it looks like the market is concluding that Iran's reactive function here is extremely limited. If it were to close the Strait of Hormuz, we know that it would anger China and we know that it would damage its own inflows of consumer goods.
Yep.
So that unlikely. We know that if it hits US bases in the region, let's say Saudi Arabia or Qatar, those countries are just going to unleash their sovereign wealth funds and help the US to retaliate again against Iran. So again, looks unlikely. What could they do? They could hit the commercial vessels in Yemen via the Houthis, right? They could strike at US bases in places where the government's poor or unstable so that there isn't a help to the US to retaliate. Our analysts say that you could, warn the US of what you're going to do so that the US retaliation is limited, so that the regime isn't completely embarrassed. It's done something, but basically it looks like the market reaction right now is saying there's not much Iran can actually do.
We'll dive into the nuances of the market reaction in a moment, but you mentioned China, and I think that's a key piece of this as well, because China is ultimately the biggest buyer of Iranian crude. There's a Russia component to this as well in terms of what the ripple effects are and how this perhaps creates even further tensions with an already not so great relationship between the United States, between Europe and Russia as well. I think it's also crucial to see what some of those GCC economies do as well. We've caught an eye. You've listed a series of them that have those military bases and military presence. But the folks in Saudi, the folks in the Emirates, they're already extremely worried.
They are worried, but nobody seems that worried. This is the point. Israeli markets up, crude barely budging, the dollar's a little on the front foot. Nothing signals at the moment serious concern. I don't know. The tail risks are still there, and they are still significant. But at the moment, the market is remarkably comfortable, Kriti. Walk us through it. What are we seeing? I don't see anything here that rings alarm bells.
Well, so I was really scratching my head this morning as well, because we're looking at a 78 handle on Brent. Now, we did cross the $80 a barrel threshold, so we did hit $81 a barrel. It did come back down by about $3. So there is volatility, intraday volatility, at least, that is baked into this market. I think what's interesting, though, is because when these strikes first came about, what was this, 7-10 days ago from Iran into Israel, we did see oil spike by about $10 a barrel, and it hasn't really come below 77, 75. So perhaps that's the geopolitical risk premium that we're talking about, because prior to this conflict, it was the trade negotiations that were keeping oil prices suppressed.
But people talk about 130, 150 on crude. Energy infrastructure is not being targeted at the moment. It would be a significant step for the Iranians to target energy infrastructure because of the point that we've been talking about already. China is a huge buyer of it. You do not want to upset your biggest customer.
Yeah.
So what do the Iranians do? And the market conclusion is this morning, not very much, as Lizzie says, beyond the symbolism. There is nothing really significant here that is showing up as a serious outside risk. Now, there are plenty of things Iranians could do, but the risks maybe outweigh the rewards from the Iranian point of view, from the Iranian regime's point of view that wants to stay in power.
Well, the reaction function is really interesting here as well, because there's also a question of the dependency that this global oil market has on Iranian crude at the end of the day, because you've seen come and come again, every time an Iranian headline comes, the oil market's reaction has been more subdued. And I wonder how much of that has to do with American energy dependence, but also the fact that OPEC Plus has been very willing to hike output in the face of even low oil prices, not to mention high ones. So in terms of actual supply in this market, there may be other sources that could come to the rescue.
Yeah, and indeed there has been all that speculation that Trump was asking Saudi Arabia to pump for Trump beforehand, knowing that all of this was going to happen. Speculation that's been batted away by US officials. We've also got to keep an eye, of course, on natural gas as well. About a fifth of the world's seaborne supply passes through the Strait. I know we're saying that the risks of the Strait being closed are limited, but you are seeing a bump to natural gas futures this morning as well.
Let's talk about how the airlines are responding. So, in some ways, the airline response, there's a favourable airline response, and on another hand, there is a less favourable airline response. It depends what kind of airline you are. If you're a short-haul carrier, let's talk about Ryanair, let's talk about EasyJet here in Europe this morning, we'll see how they open. You are likely to see a sense of relief, maybe, that oil prices are not going sharply higher. It is their biggest input cost, therefore it is a huge factor for the airline point of view. So the fact that oil is not responding dramatically is a good thing. Yes, it's up, and yes, it's going to cost more money, but nevertheless, that is a good thing. The downside is if you're a long-haul carrier, you have very limited airspace to play with going east-west at the moment, and that is the real challenge that we now face. We've seen a series of cancellations started last week from US carriers. We've seen it over the weekend, Singapore, British Airways cancelling a series of flights, turning back a series of flights. So there is a challenge in terms of distance that you now have to fly if you want to go east-west. That is an extra cost because you have to burn more fuel. But the fact that fuel has not gone to 130, if fuel went to 130, if Brent went to airlines, would be down very sharply. So I just want to know whether one offsets the other this morning.
But, Guy, given what we've just discussed about how Iran's options are limited in terms of retaliation, knowing what a hub Doha and Dubai are for these long-haul carriers, how long is that really likely to go on?
It's not going to last for very long. But there is a significant risk at the moment with an active conflict in the region of flight. Iran is a big country, and it represents a significant chunk of airspace that is being taken out in a market that has already seen Russia closed.
Yeah.
So normally you would go that way. Now you've got to go this way, and that is being closed down now. So it just represents, it is a greater challenge just in terms of distance you have to travel to avoid getting some of the more riskier parts of the world in terms of airspace. And I think that may continue for a while. And I think the nervousness within the airline sector will continue for a while. We've got some great guests lined up. We're going to be talking about all of this throughout the show. Tobias Ellwood, former UK, Middle East and North Africa Minister, is going to be joining us. John Bilton, JP Morgan Asset Management, Global Multi-Asset Strategy Head, is going to be joining us. Marcus Baker, Marsh McLennan, Global Head of Marine and Cargo. That is the conversation I'm looking forward to. How do the shippers respond to all of this? We've seen a series of vessels being turned away or turning away around the Strait of Hormuz over the weekend. And Nicholas Hopton, former UK ambassador to Iran, 2017-2018, will be joining us a little later, Lizzie, for maybe some insight into what the Iranians do next.
Yeah, let's have a look at what's on the diary for the week. Today we've got global flash PMIs. We'll see how manufacturing services have held up against the trade war so far. Tomorrow the NATO summit begins. Oliver Crook will be on the ground for us. We also have testimony from the Fed's chair, Jerome Powell, on Wednesday. Let's see if this escalation in Iran perhaps vindicates his wait-and-see approach to rate cuts. We have the BOE governor speaking as well. Thursday we have the EU Leaders Summit, and then on Friday we get that US PCE data, as well as the Fed releasing its annual bank stress test. So really, I'm focused on the geopolitics here. The NATO summit, interesting given Trump's animosity towards the institution, but it'll be more of a focus perhaps on the EU Leaders Summit. If they can't get agreement at NATO, everyone except for Keir Starmer then transfers over to Brussels. Let's see if they can agree to something there on how to move forward.
Well, we'll see what we hear from Brussels today. Ursula von der Leyen leading that meeting with the foreign ministers, at least initially today. Mark Carney is in Brussels at the moment. He still has his trade agenda kind of roaring in the background as well, looking to forge something new with the EU as well. But you're right, it's 100% geopolitics. But I'm curious how much say European leaders even have right now. And I think this is crucial at a time where there is speculation, again, or early reports that Donald Trump was considering actually attending the NATO summit.
I kind of wonder how much the focus turns back to Ukraine when European leaders have basically been completely sidelined when it came to the US striking Iran. Do they just need to focus on what they have much more influence over, which is the conflict?
This is not Europe's fight at the moment. It doesn't feel like Europe's fight. Europe is not involved. We've tried the diplomacy. That hasn't worked. Clearly, this is something that others are going to talk about. NATO, as you say, has plenty of challenges right now on its eastern flank. It has got a lot to think about when it comes to Ukraine and what Russia is doing there. That seems to have been sidelined for the moment. That's the fight that Europe needs to engage with, maybe less around Iran.
But the oil price spiking helps Putin. And yet this morning you've got Zelensky saying that Putin's going for it harder in Kyiv while everybody's looking at the Middle East.
Looking the other way.
You've got more massive missile and drone strikes, 5 at least killed in Kyiv just overnight. And Putin preparing new operations on European territory, warns Zelensky.
Well, we'll see how much of that takes up some of the space at NATO as well. We should also mention, of course, there's a question of defense spending and defense targets. And we know that Marco Rubio as well had made comments over the weekend that ultimately, when it comes to what the Europeans are going to do, sanctions on Iran might be the way that they can engage, building upon existing sanctions they already have.
Yeah, which are already fairly significant.
Yeah.
And I think it feels like we haven't achieved what we need to achieve via sanctions. The Iranian economy has adapted and responded. Yes, it is weak. What comes next? Will that change events significantly on the ground? It feels unlikely at this point. What else do you need to know this Monday morning? Let's talk you through some of the other stories that we are watching. Staying with NATO, Spain has obtained an exemption from NATO's ambitious defence spending target of 5% of GDP after several days of diplomatic wrangling. The Spanish Prime Minister, Pedro Sánchez, says the country can get defence expenditure up to 2.1%. But, quotes, nothing more, nothing less. This ahead of the NATO summit we've been discussing in The Hague this week. US State Department has issued a worldwide caution alert for American citizens, flagging the potential for travel disruptions and demonstrations following the US strikes on Iranian nuclear facilities. Global alerts from America are relatively rare. The last one was in October 2023, soon after Hamas attacked Israel from Gaza. Major US cities, including New York and Los Angeles, are also tightening security around religious institutions and diplomatic facilities, plus also public spaces. And elsewhere, Tesla has rolled out its long-promised driverless taxi service in a modest debut for what Elon Musk sees as a transformative new business line. The first Robotaxi trips were limited to a narrow portion of Tesla's hometown of Austin, Texas, with an employee in each vehicle keeping tabs on operations. The car maker handpicked a friendly crop of initial riders, which featured investors and social media influencers who live streamed their trips. Of course, that was done on social media.
Coming up on the program, we're going to take a look at the stocks to watch at the open, including European defense companies. Of course, oil and shipping will be a part of that narrative as well. Up next, though, a quick focus on the markets conversation. Ethan Deffitt, Senior Investment Advisor over at Moneta, is going to be joining the program. If you have any questions for us or for our guests, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg.
There could be secondary and tertiary impact. Let's say there is more turbulence that goes into hitting growth prospects of large economies, and then you have a trigger impact in a downward revision of prospects for global growth.
IMF Managing Director Kristalina Georgieva talking about some of the risks out there. Let's bring in Valerie Teitel for more on how markets are responding or not responding this morning.
exactly, Guy. Get a really muted response here from the U.S. equity futures, just down 0.1%. We did open up, though, nearly 1% lower. So the markets are continuing to rebound from those opening levels. Maybe we'll end the session with S&P futures in the green if this path continues. We're also seeing oil prices rebound from their spike this morning. Brent crude opened up nearly at 81.5, Guy, this morning. We've now paired those gains just up 1.6% on the Brent crude index. One thing I do want to mention that did stand out to me this morning is the amount of dollar strength on the back of this risk aversion. And Guy, this is really the one consensus trade that's been disrupted from the Middle East tensions. You can see here that since the strikes on the 13th of July, the U.S. dollar has rebounded 1.2% from those three-year lows. That is one consensus trade that continues to get maybe put under a bit of cold water, the fact that we are seeing dollar strength on the back of this risk aversion.
Valerie, thank you very much indeed. Valerie back a little bit. We'll be back a little bit later on. Ethan Devitt, Senior Investment Advisor, Amaneta, joins us now around the table. Good morning. Very nice to see you.
Thank you.
The market seems remarkably calm this morning, comfortable with what it sees in terms of the geopolitics. Is that the right response?
I think you've used the word resilience before. We've had this stubbornly resilient market, a sense that investors are looking perhaps to not miss out. Where else can they essentially be? They want to be exposed to growth. We have this kind of counter-narrative. We have America first, a strong surgical strike showing strength. I think that's why the dollar is stronger today. And then paired with that, we have the concern about higher inflation and what that means for the Fed's next move. And we still have the consumer that is resilient, but yet fraying a little around the edges. We know that through sentiment that's been quite soft in comparison to the hard indicators. So I'd say a mixed picture today as we look at, and that's probably why the market doesn't quite have a sense of direction yet.
What do you think the long-term direction should be at this point?
Definitely stronger. We have the very strong, I think, moats around the U.S. large-cap tech stocks particularly. They have a longer way to run. We know that the consumer is resilient and that the Fed, in its back pocket, has the ability to reduce rates. So that's going to be an important piece of arsenal when it comes to stimulating the economy. Really, very little has been done there yet. So I do think we're looking at a long-term, not a particularly spectacular equity market, but definitely resilient, definitely in the high single digits. That's what investors need to see.
What's the more likely scenario? The need to stimulate the market or the need to tamp down inflation? First from pressures from the trade war and now from geopolitical risk affecting energy prices.
It's an interesting question came up today about oil and what this means, but I think there is still some inflation that is transitory, despite the fact that that word tripped up the Fed many times. With COVID, it was more difficult, it was a one-off event, more difficult to predict, was it in fact transitory? But I do think with these oil prices, you can see the oil price is incredibly resilient these days. We know that it's a demand-supply issue. The U.S. has its own supply, so that perhaps the oil price is not likely to be as distorted by these tensions in the Middle East. So I think that really could be a transitory impact. So I don't think that that really deters the Fed from its long-term direction.
Well, even a guy kind of hinted at this in terms of the long-term view, but we are seeing a sense of complacency in this market. The idea that you don't trade kind of the headline risk to the same extent, or at least pair some of the spikes that you see. So what is the lazy trade? What's the de facto trade that everyone kind of resorts back to?
I think it's sitting where you are and rebalancing assiduously. So it's basically not taking a tactical view. When equities fall, top up. That has been a good strategy so far. It's difficult to call the bottom. And basically, you may as well just dollar cost average into that. And it has been maintaining also that global exposure, not trying to be too tactical. Perhaps in the past, after 15 years underperformance, you might have thrown in the towel with non-U.S. equity exposure if you're a U.S. equity investor. That would have been a mistake because that was just precisely when the dollar started to turn and when non-U.S. markets started to outperform. So I would say stick to your knitting. It's not the most exciting advice, but also be wary of so-called safety trades like Bitcoin, because as we've seen, Bitcoin is actually anything but a safety trade. It's not a diversification against U.S. currency debasement or other currency debasement. It's been falling just like other risk assets today.
Shall I be the one to bring up the unlikely ifs, Ethan? How do you position for the risks that are really outside risks? You know, what if this does become a protracted conflict and the US is drawn into it? Where does it take Treasury yields when, you know, we're already concerned about the fiscal backdrop?
I think that's a really interesting point. Usually Treasuries would be that risk-off trade, that safety trade. And as we've seen, it's been anything but. We have seen some quite heavy selling off of Treasuries, whether it's through technical things, selling of the US dollar and Treasuries, or whether it's just through concern around the fiscal deficit. I will say those kind of concerns around the fiscal deficit markets. It definitely gets put on the back burner when we have spending on defence at the forefront and this kind of a geopolitical development. So where is the safety trade today? Again, it's going to be a little bit in bonds. There's a decent return there. We may have a more support for risk-off trades. As I said, it's not what these new emerging risk-off trades. And I'd say, if anything, it's maintaining global exposure because, as Guy pointed out earlier, this is not Europe's fight, really. So therefore, having global exposure gives you exposure to regions less exposed to the geopolitical conflagrations that we're seeing right now.
And the other big if that analyst after analyst tells us is unlikely to happen, if the Strait of Hormuz is closed, and Bloomberg Economics says oil could top $130 a barrel, how do you position for that without overreacting?
I don't think will have time to overreact in that case. I think that's the point, is that these type of things really react very quickly. That's what we're seeing in markets, that the cycles are much, much shorter today. So there should be, across every every portfolio, some exposure to energy stocks. So we know that the energy trade, whether it's traditional energy or even renewable energy, that should be in every portfolio. So that should perform strongly. And then there will be winners and losers to every kind of spike like that. So having a broad-based exposure without technical concentrations and sector concentrations is likely to be the best trade.
Even how different would the kind of portfolio that you're describing be versus where we were a year ago? Has anything really changed in your mind in terms of the investment landscape over the last 12, 18 months?
I think what's changed is that some of the trades that had little love have started to get more attention, say the value trades, the infrastructure, the more defensive trades. But it doesn't feel that significant. You're still talking about kind of big tech as being the anchor of an investment portfolio. That investors should expect high single-digit returns. Now, those are not the blow-away numbers of the kind of the mid-teens, 20s, etc. we've seen over the last few years, but that's still a very good. Does the market just keep powering on? Like, where does what is it that keeps us going? Is GDP growth strong enough? Am I being rewarded for inflation? It feels like something has changed, but nothing has changed, and that strikes me as being curious. And back to kind of Critty's point about complacency, is the market comfortable with the risks it has at the moment? And the knee-jerk response, therefore, is if I see a dip, I buy it. I continue to average in. It's still a market that goes higher for me. We have far more risks in the market today than we did 18 months ago.
Okay.
The market's not reflecting that per se. The risks that are different, for example, are the tariff risk. This is at the back burner again in terms of news attention today, but that's 90 days are coming up soon, and we know that markets did not react as they should have reacted in a worst case scenario. So there was a sense of it perhaps being put off or kicked down the road, but there was nothing. So that's one risk that is definitely higher today. Geopolitical risk is definitely higher today. We have more flashpoints than we did before. Yeah. We have the risk of default in the credit side, that the credit has been pumped up. This private credit explosion, over $3 trillion in private credit. We haven't seen defaults. We haven't seen any creaking or just pain shown from the rates that have been high and still stay high. That perhaps is out there. We hear about risks in private equity, that is the chicken coming home to roost. That hasn't yet occurred. The list is quite long by the sound of it. The list is long and it has not been reflected. But what is different today in terms of markets is we had much more of a high concentration in the Mag 7s 18 months ago, and really languishing performance ex-US and in the value sectors. That's starting to be more balanced today.
Ethan, I'm putting you on the spot, 30 seconds, just because you mentioned the private equity space as well. There's a question here of where the yield hunt went. Not too long ago, everyone was diving into the carry trades, emerging markets, private assets to get that extra yield. Is this the end of the hunt for yield?
I think investors will always be hunting for yield, and we can see that when any kind of a yield trade shows itself, simply because even though there's still decent returns on cash, so at least you don't have to seek yield that much. You can still get a decent return on cash. But we see pretty much enduring demand for private equity, private credit right now, despite this shoe to drop or chickens coming home to roost or whatever metaphor you choose. So there is still high demand there. So I think we haven't seen any cracks yet appearing.
All right, cash still has a juicy yield. Interesting. Ethan Devitt, Senior Investment Advisor over at Moneta, joining us this morning to dive into how you should be positioning in the face of all this geopolitical risk. Coming up, we're going to dive into more of that and speaking with the former UK Middle East Minister, Tobias Ellwood. That next. This is Bloomberg. 30 minutes away from the start of the opening trade. Take a look at futures. We're talking about this idea of complacency, a little bit risk off, but perhaps not by that much, unless you look at the CAC Iran, down a whopping 1% and selling off as we speak. The FTSE 100 perhaps a little bit more insulated from those moves. You look over in the States, you're still not seeing that much reaction when it comes to these markets. Almost flat, actually, in U.S. futures. Europe right now currently pricing in far more risk, Lizzie.
Checking in on the bond space, Christian, you've got yields up across the curve across Europe. More so, I would note, in Europe than in the US. You've got the 10-year about 3 basis points at 4.4%, but yields higher across the world, really, at this point in the morning.
So, very muted response in so many assets this morning as we just worked our way through. The CAC looks like it could come under a little bit of pressure, maybe more than most. London looks like it's going to have a better day with some of the oil trades maybe working. So the US strikes on Iran have sharply raised the geopolitical risk in a global economy already facing uncertainty over President Trump's trade war. The world is now watching for Tehran's response after the US deployed those bunker-busting bombs to strike the regime's nuclear sites, claiming it has now significantly set back those uranium enrichment capabilities. Independent analysis has yet to confirm Trump's claims. For more on this, we're joined by Horizons Middle East and Africa anchor Jumana Basechi. Jumana, everybody's trying to figure out what Iran does next. What are people talking about within the region? How concerned are those within the GCC states? What are they looking for to happen next?
Yeah, there's a lot of concern. And what we know for sure is that Iran will have to respond, retaliate somehow. Remember, the supreme leader said only last week that if they deemed the U.S. to have joined in with military intervention, then they would cause irreparable damage to U.S. assets. So the question now is, what does that retaliation look like? They could go for something targeted, similar to the response to the killing of Qasem Soleimani back in 2020. Iran took about 5 days to respond then in a telegraphed attack that they did on a U.S. base in Iraq. They had informed the U.S. beforehand, so it didn't result in fatalities, but it was enough back then for the regime to say, look, we have responded, and that's the end of that particular retaliation, similar to what happened between Iran and Israel in the episodes last year. But if they wanted to escalate things even further, they could go down the route of hitting U.S. assets dotted around the GCC. There are several military installations, but again, that would be very inflammatory because of the nature of the relationship these days between the Gulf Arab states and Iran. Over the last couple of years, there have been many diplomatic channels and mediation attempts that have gone down between those Gulf leaders and Iran to try to bring down the temperature in the region. They would probably don't want to set up an adverse chain of reaction, of effects when it comes to the Gulf states as well. Beyond that, it's a question of restarting the proxies. And we've been talking on the show as well about how some of those key proxies in the region, the likes of Hezbollah, have seen their military capabilities severely eliminated, their political clout also diminished as well. So unlikely at this point, and this is what we're hearing for the Lebanese government, that Hezbollah would look to get involved in this war. But over the weekend, we heard from the Houthis, and they once again have threatened to attack U.S. assets in the region as well. So there are multiple channels, and of course the one that energy watchers are looking out for is whether Iran would go down the route of disrupting shipping through the Strait of Hormuz. I think most people also understand that should Iran go down that route, it would be somewhat suicidal for them because it does constitute a main lifeline for their own economy, given how much of their oil has to pass through that Strait of Hormuz to get to their main buyer, China.
A key argument both J.D. Vance and Marco Rubio in the States have made as well. Jumana, just give us a little bit more insight on the attack specifically on those nuclear sites. How much damage was actually inflicted?
Yeah, I mean, that's the key question for the ultimate success of these attacks, and whether, as the U.S. are framing it, it's a one-off attack or whether they may have to do more in the future. The latest assessments that we have from the IAEA suggest that there has been further damage inflicted on Isfahan. Remember, that was the site that was hit by Israeli attacks last week. They say the latest attacks early this morning damaged other buildings in Isfahan. We have established that entrances to those underground tunnels at the site were also impacted. Natanz, which is another enrichment site, previously extensively damaged, was once again attacked. And when it comes to Ferdo, which of course is the facility that has these stockpiles sitting in an underground storage, there IAEA say it was not immediately possible to assess the extent of the damage. It was clear that Fordo was impacted, but the degree of damage inside the uranium enrichment halls cannot be determined with certainty. And this itself raises questions about the efficacy of this strike, because the Iranians have been saying that in the run-up to these strikes, they've managed to move these stockpiles around to an undisclosed location. And at this point, IAEA can't verify where those stockpiles are sitting. And so from the Iranian standpoint, they're still sitting on potentially these stockpiles, they're still sitting on equipment, and they're still sitting on the know-how should they want to restart the nuclear program once again in the future. So this all comes back to the question of how much of a fatal blow has been administered on these nuclear sites, and has it completely depleted Iran's ability to build a bomb? We don't know the answers to these questions.
Okay, Bloomberg's Jomana Basechi, anchor of Horizons Middle East and Africa. We thank you so much for your coverage. Now, in terms of the European perspective here, the British Prime Minister Keir Starmer has called on all sides to negotiate a diplomatic end to the crisis, warning of escalation beyond the Middle East. Let's now bring in former UK Middle East Minister Tobias Ellwood. Really good to have you with us, Tobias. We were just hearing from Jomana Basechi there about how perhaps this isn't necessarily the quick win that President Trump is portraying it to be. Perhaps it actually complicates the hunt for Iran's nuclear weapons. Has the president made it even more likely that Iran becomes a nuclear power now, do you think?
That is the big question indeed. Seeing such a pivotal moment unfold in front of us and what's going on in the Middle East. America joining this war with Iran, firstly, it distanced itself from those initial Israeli attacks, then kept the world guessing, offering a 2-week window, but now as lead combatant, advocating regime change. So we're all adjusting to what this means and where it goes next, expecting that big Iranian retaliation. In one sense, though, this major attack by America has long been on the cards, finally challenging Iran's decades-long destabilizing influence across the Middle East, and critically preventing Iran from developing that nuclear weapon you've just been speaking about. America calculated probably that it's never been a better opportunity to hit Iran, to push that nuclear program back and diminish Iran's regional influence. But as your question implies, the big reality check here, and it's why America has hesitated for so long for getting involved, for attacking Iran, is that we are simply now in uncharted territory. We do not know the scale of Iran's response. And I think it's miscalculating. It's not good strategic thinking to then push Iran, push the regime in a corner. If they've got nothing to lose, they will absolutely release the hundreds of ballistic missiles they've still got left in, attack other nations, including Britain, to escalate the entire conflict, drawing other nations in deliberately, knowing that they're probably on their way out.
But do you think that's likely? Let's say that Iran doesn't retaliate by blocking the Strait of Hormuz for all the difficulties Jomana listed. Let's say it doesn't strike US air bases in the Gulf because it wouldn't make sense to bomb another Muslim country, especially rich ones that could bankroll the US retaliation. Where do you expect to see that Iran retaliation hitting?
Well, going back to that proxy influence, Iran still has criminal groups, extremist operations in Iraq, for example. It's they who could then do the damage to the US bases. It's the Houthis that could do damage to particular shipping that go through the Red Sea. Likewise, with shipping that goes through the Straits of Hormuz, they could select their own targets, which would actually send, I think, panic through the international markets, but potentially protect their own exports. You touched on just before the importance of China to Iran, and that raises a wider question as well. The foreign minister is visiting Russia today, so these are other stakeholders that will have a say. This is a multipolar world that we're now living in. Where again, I would urge caution with America calling for regime change. Is that there is not a democratic body sitting in the wings waiting to step in. This is an enormous country, sectarian divides there, and were it to lose its leadership in an abrupt way, probably would lead to civil war and a dictator, the head of the military, likely stepping in, taking over the country. Is that really where we want Iran to go?
Tobias, good morning. It's Guy. Do you think President Trump, therefore, given all the risks you've just laid out, was wrong or right to hit Iran this weekend?
You know, we can ponder that, but it's now academic, if we can say that. The reason why nations, including Britain, were urging caution is because we just moved into the unknown.
Sure.
And look at what's happened before, when a mighty superpower has used its superior military capability and its intelligence to defeat a regime. That's the easy bit. Securing the peace and stability is the harder bit. Just look next door at Iraq. Look at Afghanistan. Look at other examples in American history. It's not so easy to then gain the stability and security that you're after.
Was the risk of a nuclear-armed Iran a risk that was too great? Is that risk worth taking to defeat it? You've got to kind of balance the probabilities here and the risks that we are running. And one of those was a nuclear-armed Iran that potentially was getting close to achieving that weapon status, and therefore that was a risk that was not something that the United States was prepared to live with.
Yes, you're right. That is the trigger point for this, that IAEA report saying that Iran was moving not from 3% for civil purposes of enrichment, but up to 60%. And that's not a stone's throw away from 90%. It's easy to do that last upgrade and be able to develop a number of bombs. And that was a red line, not just for America and Britain, but actually much of the Middle East as well. And Iran armed with a nuclear bomb was a clear red line and would really have distorted the power dynamics across the region, even more so than it's doing now. But don't forget, America was having talks behind the scenes with Iran and then got drawn into this because Israel actually had their own interpretation of the speed in which Iran was going to develop that weapon. But it actually doesn't matter now because this has now happened. The attacks have now taken place. We don't know the scale of the damage. And again, as your reporter was just commenting on, the knowledge there of how to procure another weapon in the future absolutely remains. And we still don't know whether Fordo was the only underground bunker that Iran was operating.
Tobias, it's Creedy in London. I want to continue the train of thought that Guy had there. Now that Donald Trump and the Trump administration, the United States has had this strike, in the hours after, he's talked about the idea that if Iran were to retaliate against other U.S. military bases or sites or troops, etc., there is a risk that there is another response from the United States in response to the retaliation. My question to you here is, upon request, do you think that the UK would join in if the United States asked for extra help from the UK?
These are the back channels that take place. It was interesting that Diego Garcia was not used in these attacks, and that then didn't put Britain into a difficult position to have to grant permission for that to happen. I think it's more whether Britain would be attacked as well. I don't think at the moment that Britain has any intention of then joining with America unless we are drawn into this by our own military positions coming under bombardment. But what happens next, this is why diplomacy is important, is to spell out to America, look at your own past, look what you've done when you've waded in with your military might and not thought about the consequences. How does battlefield success translate into some sort of strategic stability? There's an absence of that hugely in Gaza, and now we could see this in Iran. I make very clear that there is the regime is unpopular, there's no doubt about it. But there are many, many views, many, many stakeholders, many, many groups that will then be vying for power. And at the front of the queue will be the military itself wanting to actually take over. This is all has to be put into the mix. And it's the dangerous place you go to if you now go for regime change.
Tobias, Lizzie again, where does this leave Kyiv? Do you now see the US rerouting equipment to the Middle East? And does that mean that Europe instead should just focus completely on Ukraine?
I think it's a really important question because it's part of the reason why Donald Trump wanted to pull away from interests in Europe. He didn't see this as an American interest anymore, looking at very rich countries saying, look after your own security. I've got other parts of the world that I need to actually focus on. Also, I think Trump has a strategy, too, of allowing big beasts, if you like, to have their spheres of influence. With Russia, that included Ukraine, and America seemed to be content with that. Now, the folly of that, of course, is that Russia won't stop there, and we all know that. So persuading America that for America and Europe to be on the same page, security-wise, absolutely makes sense. We've touched on whether or not Europe or the NATO would then come in to support America if a wider war took place. That's why you try and keep your friends close to you. But ultimately, you're right. There's too many red lights now flashing on the global order dashboard. It shows how dangerous not just the Middle East becoming, but our entire world.
All right, former UK Middle East Minister Tobias Ellwood joining the program this morning, giving us some analysis about how to interpret the events of the Middle East. We thank you so much. Coming up, airlines and defense stocks largely in focus as we look towards the market open. How are those two sectors bracing and pricing in the conflict in the Middle East? We'll dive into the details next. This is Bloomberg.
Just over 10 minutes away from the opening trade, and what's perhaps notable this morning is that when you look at the European futures picture, actually none of the indices are down more than 1%. US futures are actually pretty flat at the moment. FTSE 100 futures not set for such a low open as the rest of Europe, perhaps because of the energy exposure, because you've got oil up, but Eurostoxx 50 futures down 0.7% at the moment, Guy.
Yeah. Comfortable response. Everybody feels pretty comfortable with what is happening right now. Is that the right response? Is this a market that is complacent, or is this a market that is resilient? Mark Cudmore, Markets Live Executive Editor, joining us now. Mark, everybody's pretty comfortable right now with what they see in front of them. There doesn't seem to be any significant tail risk that we should be factoring into our thinking this morning. Iran is not likely to respond in a significant way that's going to disrupt global trade. Is that the right way of looking at this?
I think it is the correct way to trade this until we get a fresh development. I don't think markets experts should pretend to be geopolitical experts. All macro traders become armchair experts in absolutely everything under the sun at some brief point in time. But the point is, people who are trading, whether it's stocks or bonds or currencies around the world, they do not know how or when Iran will respond. Until then, the narrative at the moment is this is being traded as a very successful intervention by the US. The fact is the dollar is strong, Middle Eastern stocks traded higher, and we're seeing subdued reaction elsewhere. And that all piles up to kind of say this is being traded as ending uncertainty around Iran's nuclear program. And therefore, that is a big victory. And therefore, that is the current theme at the moment. And that's the way that it's sensible to trade until we see something to change that narrative again. It's not ruling that out.
You talk about a successful operation from the United States, perhaps boosting some of that sentiment as well. But Mark, I'm curious what that line in the sand is. What would create a more pronounced reaction? Yes, Iran may respond, but it's quite clear that the U.S. would retaliate to any sort of retaliation. What is the response that would trigger a more volatile market reaction?
For markets, look, and there's obviously a very important humanitarian issue here. Conflict is always terrible. So I just excluding that and just focusing on markets. For markets, all they care about is if the Strait of Hormuz is sustainably blocked. We're not talking about disruption for a few hours or a couple of days. We're talking about sustained disruption to the Strait of Hormuz. Apart from that, anything else is a headline that will get faded, because that's the only thing that stops regional flow of oil and affects the world economy. And that's basically what people are looking for. Mm-hmm. So until you see that development, every other headline will cause a risk off, but will then be faded.
Mark, is the dollar back to being a safe haven now? Goldman's saying that the dollar decline may have been overdone, and it's up 0.25% on the Bloomberg Dollar Spot Index today.
It's not back as a haven. You've got to remember the US benefits from higher oil prices. It's the world's largest producer of oil. It is much more insulated from oil prices. This is very different from several decades ago. So it benefits from higher oil prices. It also benefits from the support from interest rates in the short term. So I think this is a theme about, sure, there's a slight haven bid. There's a slight flow into the dollar because there's a little bit of de-risking at the margin. And that means a deleveraging into the world's reserve currency, which the US dollar still is. but it's not really performing as a major haven because we're not seeing a drive for havens. We're not seeing a risk-off event. Gold is lower, treasuries are lower, so the dollar being slightly higher shouldn't be mistaken as a sudden new refreshed haven bid for it.
OK. Bloomberg Markets Live Executive Editor Mark Cudmore, we thank you. That's how it's all playing out in the macro picture. Let's turn to the micro picture. Joe Easton's here with our stocks to watch. Joe.
Morning, Lizzie. So one area we are going to be looking at today is the defence stocks. As you guys have been mentioning, the actual reaction across the broader market hasn't been as huge as we might have expected, but defence shares are moving higher on the Tradegate exchange this morning. So we will probably see stocks like Rheinmetall, BAE, Leonardo all edging back higher. Again, I was seeing gains of around 3% on Tradegate today. And there is a note out from Bernstein saying that they probably do expect this to lead to added pressure on defence spending around the world, given we tend to see that when big events like this happen. So I would expect to see some movements in those shares today. Then the other sector probably actually going the other way is airlines, a twofold effect for this one. Firstly, we've got the rising oil price, not good for fuel costs for the airlines, and also the disruption with cancellations in the Middle East coming from British Airways and others as well. Then Novo Nordisk, keep an eye on that one as well. Some rival data from Eli Lilly on a weight loss pill. We're seeing brokers calling Novo Nordisk lower today on competition concerns. Potentially we're going to see Novo heading back down. Keep an eye on that one as well as the sectors in focus today.
Joe Easton walking us through some of those potential stocks to watch. We thank you so much. He's, of course, also going to be hitting oil and some of those shipping stocks as well, because we are still waiting to see, as Mark Cudmore just mentioned, the Strait of Hormuz and whether or not that is not only disrupted, but closed for a sustainable amount of time, in Mark Cudmore's words. So a quick look at futures here, because they are continuing to sell off. A major divergence from the picture you were seeing over in the States. About an 0.7% decline on the French index. The opening trade is up next. Stick with us. This is Bloomberg.
Monday morning, good morning. So in theory, a lot changed this weekend. The United States attacked Iran, a major event we have all been waiting for. If you look at the market reaction this morning, you think nothing had happened over the weekend. I start with crude, probably the best sort of metric you've got in terms of judging what the risk story looks like, considering what we're watching with the Strait of Hormuz to happen next. Brent crude on a two-day basis is down by 1%. Down, not up, down. That's the picture. We've got a spike higher. We faded that. That's just on the session. But on a two-day basis, you are lower. European equity markets were higher on Friday. We're going to unwind some of that this morning, aren't we, Lizzie? But not by much.
Yeah, look, it's red across the screen when it comes to the European futures picture, Guy. But look, nothing down by more than 1%. I would note that stateside futures are pretty flat at the moment. Less underperformance for the FTSE 100 futures. Maybe that's because of the energy exposure, but that applies to the CAC as well. The short and short of it, though, not that worried, despite the big geopolitical news over the weekend. Critty.
Yeah, absolutely. And that's where the sector focus really comes in. And Guy mentioned the Brent crude move. We're, of course, going to see perhaps some of that magnified in the oil sector space. And that, of course, as you mentioned, insulating perhaps the FTSE 100. The other kind of derivatives of that story is going to be in the shipping space. We have one eye on the Strait of Hormuz. It's not just about the commodity sector. Of course, the broad shipping story. How much does that weigh in on the rates picture and effectively cargo rates and tanker rates as well? And then, of course, on defense, because the NATO summit does kick off tomorrow. So we are going to keep one eye on that. Plus, of course, in the last 24 hours, 48 hours, we did hear from NATO officials and from Spain as well, just saying they're getting an exemption when it comes to that defense spend. What does that do to appetite for that complacency trade when it comes to defense stocks, Guy?
We're going to watch that very carefully. Remember Friday. Remember that European markets were higher on Friday for the most part. Think about that when you watch the numbers that you see on the screen this morning. London was a little lower Friday, but most of the European markets were higher, 5, 6, 0.7%. Then you need to factor in the numbers you're seeing on the screen this morning. So the FTSE 100 flat as a pancake this morning. Nothing to see here. The Stock 600 is down by 0.2%. Do we get some more momentum to the downside? Yeah, probably, but not by much. We're not going to see that market dropping dramatically. The IBEX is down by 0.6%. We're thinking the CAC maybe down by 0.7%. The DAX maybe something similar. There you go. The CAC's down by 0.5%. But go to your Bloomberg terminal and take a look at the GIP2, the two-day chart of these markets. You need to see it in the context of the rally we saw on Friday and the very small response we are seeing today. So the CAC is down by around 0.5%. We'll see how long it takes the DAX to get open this morning. Maybe there's a little bit more action there. But this is not a market that is hitting the panic button by any stretch of the imagination. Lizzie Critty, what's the sector story looking like?
Well, if you look at the sectoral breakdown, you've only got energy in the positive territory, up by about 0.6%. Look at the likes of Shell, BP, Total. Shell up 1.2%, BP up 1.6%, Total as well up 0.8%, off the back of the oil price moves. Brent higher 1.3%. But look at what's in the negative here. So travel and leisure near the bottom of the basket, down more than 1%. As we know, we've got airlines like BA closing flights to Doha and Dubai because of the geopolitical risks, and so that hitting them as well. Critty, you would flag that we should be looking at the shippers. You've got Muller-Maersk up 0.6%, but Kuehne and Nagel down 0.4%, same for DSV. The other thing we should note, of course, is what's ex-dividend today. So Leonardo not trading, also, by the way, ST Micro. But as we look at the rest of the defence space, Rheinmetall up 0.5%, Saab down 0.7%. A mixed picture, actually, when it comes to the defence names.
It's a fascinating one here because on the one hand, you have to factor in the geopolitical space in the Middle East read through. On the other hand, some of the headlines that may be coming out of NATO and, of course, the EU foreign ministers meeting as well today. But as you mentioned, you went through some of the energy names. We should mention that ASML is actually higher this morning. And I think that's interesting because the broader landscape is negative, including in some of the other tech names as well. ASML holding out as an outperformer, higher by 0.7%. Very interesting dynamic there. We've also been bringing a lot of attention to the underperformance when it comes to the French index. A good chunk of that can be attributed to two names, and that is LVMH and, well, I'm going to go with actually just one name, just LVMH, because that is the heavyweight that's bringing it down. The screen changed as I was speaking. It's a crucial one, though, as well, because there is a potential China read-through to be thinking about here. If you're worried about an inflationary impact on China, if you're worried about what the Iran story does to that relationship, the Russia read-through, perhaps there is a question of sentiment in terms of how that feeds back into names that are more exposed. That's just one theory. It's a second derivative move. We'll see if that actually holds. But let's see how we're supposed to be navigating these markets. We've got the perfect guest for you this morning. John Bilton, Global Multi-Asset Strategy Head at JP Morgan Asset Management, joins us around the table.
Morning.
Good morning. Thank you for joining us. Thank you for helping us make sense of these markets. We've been kind of wondering how much of this is just trading or avoiding trading headline risk and coming back to what we're calling complacency trade or a lazy trade this morning. What's the lazy trade for JP Morgan?
To my mind, the lazy trade in any market when you get an event is just to panic and go with it, because what normally happens is you find that you're missing the bigger picture. And it's, you know, the talk this morning about obviously the attacks, the impact on oil prices, impact on some of the safe havens. We've seen some of the shadows of that, you know, spike higher in oil, a little bit of a move in the dollar, etc. But it's missing the fact that this is part of a broader dialogue. We know there's been conflict between Israel and Iran now for some time. General feeling that Iran's capacity to respond has been somewhat depleted. And then the saber rattling about shutting the Strait of Hormuz, which would affect 20% of the world's global oil supply. Great for headlines, but then you follow through and actually ask, how practical is this? And I sense that markets are judging that the response may not be quite as dramatic because Iran would risk antagonizing others who are not yet pulled in, the Russias, the Chinas of this world. So if you actually take a step back, what's going on, I think, is still a market which is absorbing a gradual slowing in global growth, absorbing a geopolitical event that's going on, and actually judging that this does not, on face value, increase the change the direction of travel. It probably increases left tail risks. But at the moment, the market, I think, is being fairly calm about this.
Well, John, talk to us a little bit from a sector perspective here, because yes, there's geopolitical risk. Yes, there are now 3 areas of conflict that we have to talk about in just EMEA itself. The trade in the last, I want to say since the start of the year, has largely been diving into defense stocks. Part of that is the conflict. The other part of that is, of course, the defense spend out of Germany, et cetera. There is now a NATO summit coming into this week. But in the last 48 hours, we've actually heard of an exemption for Spain when it comes to that spend. Does that undermine a question around whether defensive stocks or defense stocks are the defensive play?
Well, I mean, if you look at defence stocks so far this year, excuse me, they've already performed very, very strongly. I think what's being missed is the fact that, whether we've got a degree of, differences country to country in terms of input to NATO budgets, if you take a step back, we've still had massive fiscal stimulus coming through in Europe. And, of course, the defence names have been the primary sort of beneficiary of this. But if we're now in the middle of this year, if If we look at the next 12-month earnings, we're beginning to factor in next year's economic momentum. Germany is spending 11% of GDP on fiscal boost. Fiscal year 26, fiscal year 27, that's a big deal. And that's something which I think will boost the European economy overall. So focusing very narrowly on the defence stocks, frankly, I'd pass that across to a defence sector expert. But in terms of the economic outlook, we've been used to Europe sort of bumping along at or below trend for a decade and more now. And in fact, we're beginning to see that there's some reasonable topside to growth risks there. And I think that's where things are starting to move. We've gone through this year having seen European earnings being priced down from a 9 to 10% gain this year to around just 2%. Eurostoxx has flatlined over that period, but we're now beginning to look into next year where the impact of this fiscal boost will come through. And yes, that's potentially supportive for some of the defence names, but Europe more broadly actually is beginning to look like it could have some earnings uplift.
John, good morning.
Good morning.
Are risks growing or declining for equity investors?
Well, we're about to come into earnings season, so, I think by definition, risks are picking up because we're about to get the tape tell us how these companies
And what do you think
doing.
it's going to tell us? Is it going to tell us that companies are absorbing the risks, or is it going to tell us that their customers, the end consumer, is absorbing the risk at the moment?
I think it's going to be a bit of both. If we look at what's happened in various US names over the both retail sector and industrial sector, there's a bit of a mix. Some of it, yes, inevitably, and I think you're probably inferring sort of trade and tariff impact here. Yes, it's going to go onto the consumer, and yes, I mean, there will be firms who've got pricing power. But I think it's been surprising how many firms have said that we think we can absorb this through substitution, etc. So I think it will be a mixed bag. I'd look, again, more deeply, wouldn't take the trade and tariffs on one side alone without thinking about the tax implications of the bill that's working its way through Congress, which potentially changes the investing landscape through...
How?
Well, through R&D capitalisation is a good example. Because if you look at the...
Does it mean high yields because we're worried about the deficit?
Well, bond
market... the cost of capital are going to be higher?
At the margin, potentially. But, you're getting an offset. Credit spreads have come in. Bond yields have been sticky at the upper end of their range. Cost of capital to corporates, it's a bit of a round trip, all things told at the moment. So, I think corporates are looking through this near-term volatility. And remember, they did a lot of terming out of debt. Corporate balance sheets are in really pretty good shape. So you take all that together, no immediate alarms going off on the cost of the balance sheet. Potentially at an index-wide level, something of an offset between R&D expensing versus the tariff impact. Big sector differences, though. So sectors like, technology, communication services, consumer discretionary, getting a boost from those tax bills. Other sectors may be getting more of a headwind from it. So I think it's important to look at the sector level, but at the index level, I can understand why the market's fairly calm about it right now.
John, Critty asked you what's the lazy trade. What's the idiosyncratic trade here that could surprise to the upside?
Well, I think there's a lot of talk about sort of ongoing concerns in countries which are price takers in energy. Take the Chinas, the Japans of this world. It's worth noting, I mean, there was concern being voiced at the top of the programme in terms of, the pass-through effect here for China. Will it create some inflationary pressure? Let's take a step back. China has a disinflation problem, not an inflation problem. At the margin, this is something which does not really change the direction of travel of the PBOC. China's one of the best performing equity regions this year, and it's still relatively cheap. Japan hasn't moved. Yes, it's a price taker in energy space. Yen's somewhat stronger than where it was at the beginning of the year. Again, could this be absorbed? So the idiosyncratic trade may be to look at some of those price takers in energy and actually realise that there's perhaps a little bit more resilience and valuation support there than perhaps has been considered.
OK, that's really interesting. And you also said don't panic. Where is the most dangerous false sense of security in all this?
Oh, gosh, I mean, it's always easy to sort of try and sort of think, OK, this looks too expensive, it should roll over. And I think a lot of people will probably go back to the typical bellwether large-cap US stocks. The S&P 500 is trading at 22 times forward earnings. That's 6 turns above its 20-year average. What's not reflected is just how much cash and earnings these big firms spin off. And, of course, if they're well held, folks will sell what they hold. But actually this secular story on these stocks in terms of earnings, growth, etc., we still feel is pretty strong. So near-term risk, if we were to see markets wobble a little bit, you're probably going to see your winners sold. But to my mind, that's a good opportunity to be able to lean into what we think is a really, really powerful secular trade, which is still relatively, relatively low in the batting order in terms of how far it's got to go.
John, great to see you. Thanks for
Great to see you, Tim. Thank you.
Always appreciate it. John Bilton, Head of Global Multi-Asset Strategy at JP Morgan Asset Management. Quick look at the Core 6 before we turn to Joe. This is what we're looking at on the board this morning. As you can see, a single stock in positive territory. Tech is actually having a fairly good day. It's interesting that Nestle is barely budging this morning. Where you are seeing weakness is a market that is trading maybe out of luxury a little bit. You've got Novo Nordisk trading a little softer as well. Some of the chemicals names are also seeing some weakness too. Joe Easton, what do you got?
So the sector really catching my eye at the open, Guy, is the airlines. Pretty significant declines in the likes of IAG, Lufthansa, Air France as well. Now, remember, we did get headlines around the weekend around some airlines actually cancelling flights into some parts of the Middle East. We saw some updates from BA of IAG and also some of the other airlines in that region, Singapore as well. So that does seem to be feeding through. And also the higher crude price, again, fueling fears around jet fuel as well. So airlines significantly lower at the moment. Then in terms of a single stock catching my eye was Stellantis over in the car makers. A bit of an update on their management. They've got some management changes out today, and there is a takeout from one of the brokers over in France saying that one of their executives potentially might be moving over to Renault, could be a competitor to the new Renault CEO, according to them. And that's spurring a little bit of worry for that stock. It gapped down around 5% at the open of trading. It's come up a little bit now, but we are seeing Stellantis a little bit weaker on those executive changes. Then we have got Novo, as Guy had on the screen there. That one is weaker. Remember, we got this data from Eli Lilly at the weekend on a weight loss pill. Now, importantly, it showed significant weight loss, but actually not that many side effects. That is seen as a positive, being a pill as well, preferable over an injection, and therefore we're seeing Novo falling on competition concerns today. Then we do have a couple of bits of M&A here in the UK as well. We had, firstly, Assura. Now, that one is in medical real estate, so it's doctor's surgeries, and we got a bid from PHP, finally getting a price on that one, but it's pretty much in line with what we were looking for, so not seeing a huge gain on that one. But the big one was Spectris, getting confirmation of Advent coming in, American private equity, buying another UK firm, keeping buying on and continuing those deals in that space. But we have got Air Liquide as well, just to finish you this one. Got a downgrade at Bank of America this morning. They say they're not so positive on the renewable energy transition. Air Liquide slipping in Paris this morning.
Joe Easton from our equities team, we thank you so much. Walking us through some of those individual movers amid a sea of red, we thank you. Coming up on the program, as Joe mentioned, American and European airlines pausing flights to destinations in the Persian Gulf. All as tensions in the region escalate. We're going to dive into the details next. This is Bloomberg.
Welcome back to the programme. 8:17 a.m. here in London, and we've just had crossing the terminal the latest French PMIs, a read on how the tariff war is affecting the euro area economy, and you're seeing surprises to the downside across the board for manufacturing, services and at the composite level. The expectation was for manufacturing and composite numbers to hold, services to improve. In fact, all have slipped further into contraction territory, and you're seeing euro weakness as a result. We're down 0.2% at a 1.15 handle now on euro dollar. So that's the trade story. But of course, geopolitics very much in focus for the rest of the market.
So many challenges, particularly for the manufacturing sector. As you say, 47.8 is a much weaker than anticipated number from France. Let's talk about one area that we're all focused on this morning, and that is what is happening with the Middle East. It is reaching into various parts of the market, and we're trying to understand the various implications of what we are seeing on the screen in front of us. One area that we're certainly seeing an effect come through into is the airline sector. Airlines very sensitive to what happens with the fuel price, but there's also the airspace and risk factor that we need to worry about as well this morning. Joining us is Benedict Camel, who leads our global aviation coverage, to cover this area. Benedict, we've seen some cancellations over the weekend. What's the latest? Where are we this Monday morning in terms of flights in and out of the region?
So what we've certainly seen this morning is that more cancellations are happening. We've seen airlines out of Asia, like Singapore, like Japan Airlines. They've started cancelling. We've even seen some countries or some companies pull their locals out of certain markets. Bankers in Japanese bankers in Dubai are being asked to extract themselves. So certainly a sense of escalation here. The other thing is it's somewhat asymmetrical response. So you don't have a unified industry-wide sort of approach to this. You have some airlines still flying, you have others circumnavigating a wide corridor. If you look at sort of the region, the corridor that's really closed is anywhere between sort of Jordan and then left to right across Iran, Iraq, Syria. So that's a really big area that a lot of airlines are now avoiding, and they're either flying further south through Saudi Arabia, or they're flying further north through Afghanistan. That adds considerable flight time and fuel costs, so this is a complicated issue for a lot of airlines.
Benny, for us non-airline experts, can you just explain to us why the BA flights to Dubai are being cancelled, but Emirates hasn't done the same, when surely the risk is the same to both?
That's right, but airlines view risk differently. I'm not saying that you know, Emirates is more open to risk than BA, but there's also a sense you don't want to have your aircraft out of position. So if an airspace actually closes down, and if a country closes down, and you have your aircraft on the ground, you'll have trouble extracting your kit from that market going forward. So that's something that companies like BA, like Lufthansa, like Air France, that are further away from that area will want to avoid. It's something we've seen really over the years. If you think back to what's happening in Russia, what's happening over Ukraine, some airlines have still sort of plied those routes. So you have Emirates flying through Russia, you've had Turkish still servicing that market, but a lot of Western companies have not. So as I said, not a uniform approach. And that doesn't necessarily make it any easier for travellers wondering, how do I get from London to Dubai? Probably right now, flying BA is not a good idea. You won't get there. But Emirates still, for the time being at least, has that route open.
Well, Benny, let's talk about another element of this, which, of course, is the oil price shock. We've starting to see a sustained level, at least in terms of geopolitical risk, of about $78, $77 a barrel when it comes to the oil story. Guy was saying that this is actually an additional headwind when it comes to jet fuel costs for airlines. Just walk us through how they're preparing for potentially even higher prices.
Well, the higher prices principally come from the longer routes that they have to take. So if you add an hour or two to your flight time on long-distance route, that adds considerably to your cost, to your operational costs. You could say the flip side of that is the lower oil price, which then cuts your kerosene bill. But basically, what airlines don't want is this sort of on and off kind of sense that they have right now, the disruption that they're seeing. They want stability. They want to be able to plan. So the lower oil price might help, and that's something we've heard over the last couple of weeks. We were at the Paris Air Show just a week ago. We're at the IATA AGM, and the sort of tenor there was, yes, lower oil prices are good for us, but then fundamentally they come at a significant cost, and that is people are less inclined to travel. When people are worried, will I be able to get back, they won't book that trip. So the lower oil price might be nice in the short term, but longer term, what the industry needs is stability. They want people to feel good about booking, and that's certainly not the case right now.
Bloomberg's Benny Camel walking us through the laundry list of risks around the airline space right now. We thank you so much. Another, of course, area that we are watching very closely is how the oil stocks are really reacting to what we're seeing in the broader oil market as well. You can take a look at this. It's one of your kind of sole areas in this market that is actually rallying, and that is, of course, just magnifying the move that you are seeing in oil, especially when it comes to oil majors, perhaps even protecting the FTSE 100, I would argue, from some of the broader gains you are seeing in other sectors. Let's talk about the oil sector broadly. Bloomberg's Will Kennedy, Senior Executive Editor for Energy and Commodities, joins us around the table. Will, we were just talking to Benny there about the idea of sustained oil prices. Walk us through the commentary that you're hearing from. What does a sustained oil price or higher oil price mean to you?
Well, if we look at what's happened since Israel started its bombing campaign against Iran, I think what we see is a sustained $10 premium in the oil price. We've gone from about 67.68 to 77.78 today on the Brent price, and I think that's where the market's settled. Now, there is the potential, of course, for it to go higher if Iran decides to use oil as a way to retaliate against Israel and the United States. But I think it's worth saying that that hasn't happened yet, that by and large the oil continues to flow from the Persian Gulf into global markets. And that's why we saw a bit of a jump this morning after the US action over the weekend. And then it's fallen away because traders are really waiting to see a real-world impact on flows.
So what are traders thinking this morning? I'm sure you guys have been out talking to a lot of people over the weekend and into Monday morning. The view across markets this morning seems to be successful US operation, unlikely to deliver a significant response from Iran, and as a result of which, in some ways, nothing to see here. This has worked. We are in a better place than we were last week. Is that the view that you're getting from oil desks? Because that's what we're hearing from other trading desks as well. Is the oil community expecting something to happen, or is actually the view that actually Iran has very few options and there's not much it can do without upsetting China, without upsetting all of its major customers, so as a result of which actually energy is unlikely to continue to be touched?
That, I think, is by and large where a lot of people are on this, and they're being governed by the fact that the oil is still flowing and that globally oil markets remain well supplied. I would draw a bit of a nuance. I think in the shipping world, and we talked about this last week, I think, Guy, there is a degree of nervousness. We have seen freight rates rise rapidly. We are seeing people paying more for insurance. We are seeing reluctance from some ship owners to go into the Persian Gulf. So there is some friction in the oil trade, but that worst case scenario where you actually get a big reduction in the flow of oil out of the Persian Gulf, the one that everyone worries about, that appears not to be happening for the time being. Sure. Iran could change its mind. Iran could decide to do something differently. But for the time being, the oil is leaving all the major Gulf suppliers and it is getting out into global markets.
Well, you're seeing a bit of a disparity in how the energy stocks are performing this morning. Is that because certain oil majors are better prepared for even if it's unlikely, the Strait of Hormuz was blocked?
I don't think there's a huge difference between the different majors in that regard. Oil majors, the actual Persian Gulf region, with a couple of exceptions, isn't a huge production centre for the oil majors. Some of them have joint ventures in the UAE, but on the whole, it's a nationalised oil industry inside the Persian Gulf. So it's more about basically a price reaction, how leveraged they are to oil prices, what they need to break even at certain oil prices, and their debt profile. So I think if you look at BP being ahead there, clearly BP in the slightly difficult position that it's in with a slightly more stretched balance sheet probably gains more than sustained higher oil prices than some of its competitors. But I don't think there are huge differences between the oil majors there.
OK. Well, Kennedy, we thank you for that analysis. As we look at oil, a bit higher, and the oil majors too. Shell up 0.7%, BP 1.4%, Total 0.5%. But as you say, Guy, we're kind of calm in these markets, surprisingly, perhaps. And we also have US futures pretty flat now in the upside, as Valerie had predicted earlier in the programme. We're going to focus in on another area, of course, that is affected by all of this, the shipping industry next. It's on high alert with all of these warnings that Tehran could retaliate against commercial vessels, perhaps via its proxies, the Houthi rebels in Yemen, for example. We're going to find out how the industry is reacting next. So do stay with us. This is Bloomberg. .30 a.m. here in London. We've got some breaking PMIs out of Germany for you, and actually surprises to the upside for the composite number. So 50.4 is where we're coming in. The expectation was for a reading of 49.1. At the services level, also a beat, 49.4. The expectation was for 47.8. But bang in line with expectations when it comes to the manufacturing number. This in contrast to the French PMIs that surprised to the downside at every level just a few minutes ago. Euro-dollar was at 1.14 coming into this. It's actually a little stronger at a 1.15 handle off the back. But this a read very much of how tariffs are affecting the continent of Europe. And it's a better picture, it seems, in Germany than it was in France, Critty.
Absolutely. And, of course, one focus on maybe how international leaders are going to be reacting to the events over the weekend. EU foreign ministers meeting today in Brussels ahead of a NATO summit in The Hague that President Donald Trump is set to attend. Now, Europe's reaction to America's airstrikes on Iran is likely to be a key focus there. Bloomberg's Oliver Crook is on the ground for us there in The Hague. Ollie, walk us through the thinking amid some of these European powers.
Yeah, so it sort of differentiates a little bit between a number of the different leaders, but I think overall the message has been consistently clear. And frankly, it's what we've heard from the international community more broadly, which is basically it is now time for diplomacy. It is time to de-escalate. Things shouldn't go further out of hand. This is a conflict that is going to end only at the negotiating table, not just through military action. So we had a number of reactions from a number of different leaders. I'd like to just bring out two for you. For one, we heard from the Russians as well, Dmitry Medvedev, the deputy head of Putin's Security Council, saying some very inflammatory things. This, by the way, has been basically his role over the last few years, being intensely inflammatory and talking through hyperbole, but basically saying that several countries were prepared to supply Tehran with nuclear weapons. He didn't go into much greater detail about who or what that actually meant, but he also said that the United States actually did less damage to the Iranian facilities than they had assumed. And we should just say that the Iranian foreign minister is in Moscow today and expected to meet with Vladimir Putin a little bit earlier. We also heard from Ursula von der Leyen, and this is the kind of key message we've been hearing from European leaders. Everyone has said basically for the last week that Iran should never be permitted to acquire a nuclear weapon. That has been sort of tacit endorsement, or at least non-objection to the military action over the last week from the Israelis, from many of these leaders. But in this tweet that Ursula von der Leyen put out, she also said that there needs to be respect for international law, and that is absolutely critical. And that is potentially a tacit criticism of the American administration and Donald Trump. Remember, we are in The Hague right now. This is the home to the International Court of Justice, the International Criminal Court. These are great emblems of basically multilateral, international system that the United States has really been the buttress behind, and that the Trump administration is really blowing up. There has been some real question about whether this strike in Iran has really been a preemptive strike, i.e. that there was an imminent threat that was going to be emanating from Iran, or if this was a long-term strategic goal that the United States basically just did from their own interests. And that is a sort of a big question. That's been one of the debates you've had domestically in the United States, and that's certainly one of the concerns that you hear from European leaders, that they're not going to put it out terribly publicly, because remember, they do still need Trump on board, and he's going to be here within the next 24 hours, expected to arrive tomorrow for these meetings of the NATO summit here.
Ollie, does Europe have a role in the Middle East conflict? Does NATO have a role? Should it have a role in the Middle East conflict, especially given what's going on in Ukraine? That conflict is still on the doorstep. That represents a more clear and present danger. Isn't that the threat that NATO should be focused on?
Yeah, I mean, that's the question I'm going to put to a number of the people that we're going to be speaking to over the next few days. And I think the reality of the situation that the Europeans need to come to terms with, and frankly probably already have, is that they're going to have a very limited influence on the Middle East, on Iran, on Israel, on the United States. However, Guy, there are going to be ways in which the situation in the Middle East and Iran are going to bear materially on the Europeans. I mean, for one thing, if Iran is severely weakened, that, of course, is a bad thing for Russia. That could be a positive for the Europeans. But on the other end of things, Guy, one of the big conversations here at NATO is about keeping the Americans on board. There are about 84,000 U.S. military personnel stationed all across Europe. Already, we know the Trump administration wants to change its attention from Europe, wants to move it over to the Pacific. If you have the United States further engrossed, further enmeshed in a huge conflict in the Middle East, as you know, they've now joined this bombing campaign, that is going to distract attention even more from Europe. That is going to be potentially another reason why the Trump administration will draw down, take some of those troops out. Remember, Biden added about 20,000 troops to that number, and the real concern for the Europeans is that the Trump administration in the next couple of months will start pulling those troops out and moving them elsewhere across the globe. And of course, there is, of course, the question of Ukraine. That is the main focus, as you say, Guy, for all of these European leaders. And the reality is, and we've known this from the start, that for Europe, they have to go about it alone, and that is going to be their sort of main concern here at the NATO summit.
OK, Bloomberg's Oliver Crook on the ground for us in The Hague. We thank you. We look forward to the conversations that you're going to be bringing us, Ollie. We'll have interviews with senior European officials at the NATO summit this week, including the EU Foreign Policy Chief Kaja Kallas, the German Foreign Minister and the Defence Minister of the Netherlands. Plenty to look forward to, Guy.
Absolutely. The shipping industry is trying to work out this morning what the risk is in the Strait of Hormuz in the Gulf. Obviously on high alert, has been for a while, worried that Tehran could retaliate against commercial vessels. The US Secretary of State, Marco Rubio, called on China to prevent Iran from closing the strait.
Well, I encourage the Chinese government in Beijing to call them about that because they heavily depend on the Straits of Hormuz for their oil. If they do that, it'll be another terrible mistake. It's economic suicide for them if they do it. And we retain options to deal with that. But other countries should be looking at that as well. It would hurt other countries' economies a lot worse than ours.
Marco Rubio talking to Maria Bartiromo. Joining us now, Marcus Baker, Global Head of Marine and Cargo at Marsh McLennan, the insurer. Good morning.
Morning, Guy.
Nice to see you. How big a risk is there now for the shipping industry? How easy is it to get insurance? Just walk me through this morning. What are the conversations happening just down the road in terms of how do we insure the risk? How has the risk changed?
Sure. Look, I mean, shipping has been one of the historical bedrocks of insurance, especially here in the City of London. And, we've always managed to find a way as an industry to cope with some of these extreme situations, be it, closure of the Suez Canal through the Ever Given, as you remember, some years ago during COVID, or these situations where there are warlike activity, which creates a heightened sense of concern and risk. So essentially what happens, every ship owner gets war risk insurance for the whole year. But there are certain territories which are deemed areas of heightened risk. And this, of course, is one area. The Middle East is one area. And there is a committee that meets with the help of advisory, people's security advisors, to assess that risk and how much it should cost to go into that region. And that's essentially what will happen over the course of the day.
How does it work? I'm a tanker owner, maybe out of Athens, and I'm thinking about pushing my ships through this region at the moment. I have a basic level of cover. Correct. I'm assuming there's an additional level of cover that now is required to allow me to insure my ships to go through that region. Who pays for that? How does it work in terms of the ultimate structure? Is it the charterer? Is it the ship owner? I imagine there are sort of conversations with everybody about who absorbs that cost. How does it work in practice, and how quickly does it work?
Ultimately, it'll be you and I.
Yep.
OK, because that cost has to get passed on somewhere. But it will very much depend upon the contractual arrangements of the charter party between the owner and the charterer as to who is actually going to pick up the cost of that war risk insurance.
Is it worth $8 or $9 a barrel? How do I think about it? Is it...
Well, I'll put it into context for you. So if we look at, let's say we've got a $100 million tanker.
Yep.
If you're trading through into the Arabian Gulf now, as of last week, it was costing about 0.2%. So that's $200,000 on top of the cost of freight, the cost of moving the ship around. That's just for the additional insurance for war risk cover. Now, is that going to change this week? Probably. But the thing to remember, no ships have actually been damaged as yet. And so how this starts to manifest itself as we go on, I think we'll just have to wait and see.
Talk to us a little bit about when you're doing that math of how much of a premium to charge on that insurance risk, how much of the thinking out of the U.S. military actually matters. And I ask this in the context here of, you mentioned the Red Sea and pricing and shipping risk there as well. So many of those rates was dependent on a U.S. naval presence or other naval presences around the world as well. Is that a conversation you're having from military experts, arguably authorities in D.C.?
So just to be clear, our role at Marsh McLennan is as insurance brokers. Sure. We're not risk takers. Sure. Our job is to find the very best prices we can for our ship-owning clients and our chartering clients. And there is a wide market. And just to put that into context, there's between $2.5 and $3 billion of maritime capacity in the world. And when I say capacity, if you had one ship valued at $2.5 billion, you could place it once. The average ship, if that's about $100 million, you can place that many times over. So there is a vibrant market that will have a slightly different view on the risk perspective. Adding the US in as a factor is obviously good from a security perspective, but this is a huge region. And so, you cannot look after every single ship that is going to trade in and out of either the Arabian Sea or through the Red Sea itself.
Is the Red Sea, the insurance rates and the kind of roadmap around the Red Sea and how that conflict has been managed, is that the accurate roadmap to apply to a potential closing around the Strait of Hormuz?
So the challenge with the Strait of Hormuz is, of course, it's a one-way street. You're up, you pick the oil up, and you have to come back down again. At least with the Red Sea, you can come in and out, or, of course, you can take a different route around the Cape. So in a way, it gives shipping a greater degree of flexibility, and that's the other thing about this industry is ship owners are they're very creative around how they can start to move stuff around the world, and that is something we may well see a bit more of, which we saw when the Houthis last started to attack shipping a year and a half to 2 years ago.
Do you think that targeting will be limited to US ships, or is everyone basically at risk? And actually, do you actually think there'll be that much rerouting take place, or does everyone just take the risk and pay for the insurance?
Well, two factors there. The Houthis actually said US, UK and Israeli flagged ships. So that was what they were targeting. Now, to be frank, they weren't entirely accurate in targeting just those flagged ships.
Exactly.
They even flagged one that was delivering grain into the Yemen. So that didn't seem to make an awful lot of sense. So I think that, we may see an escalation around that. But the other point you raised there around, will ship owners just continue to trade into that region? I'm not so sure they will. I think things have changed in the last 5 to 6 years, maybe the last 10 years, with a sort of a real concern over crew. And, in all of this discussion, we shouldn't forget about the seamen and women that are helping to deliver goods around the world, because they're the ones that are on the front line. They're the ones that are going to get hit if they want to. And so there is a move, certainly, to recognise that role and to listen to them. And if they say they don't want to go in the region, then I think they won't.
And we've talked about, the higher rates. There's also the fact that the time that quotes are valid for is shortened. It's obviously a volatile market.
Yep.
We've also been talking a lot about how boxed in Iran is in terms of its options for retaliation. If there's no retaliation, how long does the volatility last?
No retaliation from Iran?
Exactly.
Yeah, I mean, you could say in those circumstances that actually things will start to calm down very quickly. I still think it's fragile, and I think we'll see what happens over the course of the next week to decide that. You also mentioned the quote validity, which we're seeing. I've not seen that before. And what I think that is a measure of actually the concerns that the insurance market has around the volatility and around the fact that, the US is making decisions that are happening very, very quickly. And so our ability as an insurance market to react is going to be hampered, perhaps.
OK, got to stay nimble. Marcus Baker, so good to have you and your expertise with us around the table this morning. Global Head of Marine and Cargo at Marsh McLennan, Marcus Baker. Thank you so much. Coming up on the programme, the world braces for Iran's response to these US strikes. And we're going to be speaking to Nicholas Hopton, former UK ambassador to Iran. He'll join us next. This is Bloomberg.
We've long had concerns about the Iranian nuclear program and been very clear that Iran cannot have a nuclear weapon. The US has now taken action to alleviate that threat. It is important that we now de-escalate the situation, stabilise the region, and get the parties back around the table to negotiate.
UK Prime Minister Keir Starmer there in response to the strikes from the United States into Iran over the weekend. Our next guest was the UK's ambassador to Iran from 2017 to 2018. He's also the Director General of the Middle East Association. Nicholas Hopton joins the program this morning. Nicholas, a pleasure to have you. Thank you so much for your time this morning. We just heard a little soundbite there from the Prime Minister himself talking about the need to de-escalate. Nicholas, what does de-escalating look like from here?
At this particular moment, after the American attacks on Saturday night, I think Iran is facing a very difficult choice. The ball is very much in their court. The exchange of attacks continues with Israel, but Iran has to decide at this point whether it wants to escalate or capitulate. And if it escalates, that might look like the closure of the Strait of Hormuz, which the Iranian parliament has already voted in favor of. It still needs signing off by the Iranian National Security Council, but they've taken steps in that direction. It might involve military attacks on US assets, interests, people in the region. And it may well also involve using their proxies, which are much weakened, of course, following Israel's decapitation of Hezbollah in particular last year. But Iran still has cards to play, which are of various types, and economic, military, or even terrorists through their proxies.
Well, Nicholas, you've served as I mentioned, an ambassador to Iran from the UK, and we know these are two countries that have had a tenuous history, to say the least. What is the role of the UK in terms of any potential retaliation that may be coming down the pike from Iran or additional strikes from the United States? How involved should the UK be?
Iran and the UK have a long history, and there is a complex relationship between the two countries. But it is based on a degree of knowledge of each other over well over 200 years now. That's not the case for all the countries involved in this conflict. I think you will have seen what the Prime Minister said about the need now for de-escalation and diplomacy. And at the same time, the UK is moving some military assets to the region, ships, planes, to defend our interests and our people in the region in case it went the wrong way. But I think the UK's role is essentially about being part of that effort to push for further diplomatic negotiations, providing an off-ramp from the conflict for both sides. And I would hope that we can avoid being directly drawn into the conflict, which seems to me unlikely to produce the objectives in our national interest.
Yeah. So, Nicholas, you say we should focus as the UK on the diplomacy. I was listening yesterday to an interview with the Iranian ambassador to the UK. It was on the BBC. And he was saying, Iran has no intention of cultivating nuclear weapons. All countries have problems. We just need to look past Iran's human rights record. Clearly, this is the sort of talk that Donald Trump was tired of dealing with. As a UK diplomat, how would you deal with the Iranians if that's the stance that they're taking?
Well, I think we are used to Iranian regime rhetoric, which doesn't correspond to reality and misrepresents the situation. Iran obviously enriched uranium to a level way beyond what would be needed for normal civilian purposes. At the same time, I note reports from American intelligence, and including from the IAEA, which don't necessarily point to Iran having wanted to have a nuclear weapon anytime soon, although it was in a position to move in that direction should it want. I think one has to aim off with a lot of this rhetoric coming out of Tehran. They have a reputation as a nation for being very resilient. They've put up with a lot of sanctions and isolation since 1979 and the revolution. They will no doubt be preparing for the same again. And the regime itself, its main objective is to survive at this point. And the pressures on it are both external and internal. There are internal pressures also on the regime, either to evolve or to disappear.
Yeah. So in the name of survival, you have the Iranian foreign minister in Moscow today meeting Vladimir Putin. I wonder what you expect to be the level of support offered by Russia or indeed China to Iran at this point.
Well, it's been very striking in the last week how little support from its supposed allies Iran seems to have received, in particular from Russia. I think Vladimir Putin meeting Abbas Araghchi in Moscow is more a political gesture rather than any concrete military support, for example. And the Chinese may be slightly different because, of course, China has very strong interests in keeping the Straits of Hormuz open, because a lot of its oil, it takes a lot of Iranian oil, and that is exported to China through the Straits of Hormuz. So the conversations, I imagine, happening between the Chinese and Iranians at this point probably are slightly different from those happening between Russia and Iran.
Nicholas, good morning. It's Guy. Should regime change be an objective of the United States at this point? And if it is, what are the risks?
I think if one looks at the West's record of pushing for regime change in the Middle East over the last quarter of a century, it might suggest that we would be better to step back from that kind of objective. It hasn't been a great success in Iraq or Libya, for example. And generally, my view, at least, is that if countries are going to change their governance, who leads them, it's better that it comes from within, from the people of that country themselves, rather than it's imposed from outside. And often people in foreign powers, such as the United States or sometimes the United Kingdom or France, maybe we underestimate occasionally how difficult it is actually to achieve a better regime in a country that may appear despotic or hostile to our interests.
Has Israel changed the narrative sufficiently by turning attention to Iran that it has distracted from Gaza? And is there a danger that we lose sight of what is happening there?
Undoubtedly. I don't know whether this was a deliberate ploy by Prime Minister Netanyahu, but if it was, it seems to have worked. One isn't hearing with the same intensity of media focus what is going on in Gaza at the moment, because the focus is all on Iran and Israel and the United States. But that doesn't distract from the reality that the situation in Gaza remains utterly appalling. The situation for the Palestinians, civilians on the ground in Gaza is horrific, and people are being killed. Civilians are being killed, including when they seem to be queuing for humanitarian aid.
On that note, we will leave it. Nicholas, thank you very much indeed for your analysis this morning. We greatly appreciate it. Nicholas Hopton, Director General of the Middle East Association and former British Ambassador to Iran. Equity markets are barely budged. We are down a touch now. The FTSE 100 is flat. Euro Stoxx 50 is flat. Oil is flat. Nothing to see here, seems to be the market response.
It's pared back a knee-jerk reaction in the Asian session. I mean, the oil move in itself, a 5%, over 5% move at the open, now going to, I think, Brent crude higher by about 0.5%. It was almost flat earlier in the session. It speaks to the volatility, and of course, it comes as the S&P 500 ticks higher. I'm being told now we are 3% away from all-time highs on the S&P 500. Lots of market dynamics to watch as well. You're seeing strength in the dollar. That's an interesting piece, of course, ticking higher as well as we navigate some of this geopolitical conflict alongside some of the other haven assets as well. That does it for the opening trade. Pulse is up next. This is Bloomberg.